Strategy time. Let's bring in L.M.Tilman. He's the president of L.M.Tilman Co. and Andy Bruff continuing with us from Schroders for the balance of the hour. So, Leo, if we could start with you. You run a strategic advisory firm. You talk to corporations, CEOs and such. I would assume that you need to tailor your advice to their forecast and their expectations to some degree. What kind of feedback are you getting in terms of outlook, in terms of trying to give investors advice at a time that's highly uncertain?
Absolutely. Good morning. Well, first of all, it's all about macroeconomics for the time being, and we're weighing contradictory evidence about signs of stabilization on the one hand and huge uncertainties on the other hand. Whether you talk about home sales or employment, you have pros and cons pretty much in every dimension of macroeconomic forecasts. So we are cautiously optimistic, but we're highly aware of the dangers that are ahead.
What do you think is the most prominent danger?
You name it. It's out there. One is the danger of higher interest rates and inflation down the road. Another one is the fact that higher interest rates are going to impair recovery. Another one is that the housing continues to deteriorate, and combined with employment, you have consumer really retracting and the government unable to fill in the gap with its own spending. And on the more tactical level, you see nationalization fundamentally changing the nature of competitive advantages for some of the companies. So it's a wide range of macroeconomic factors, financial factors, and competitive factors, which essentially means that the companies must become much more aware of the situation and much more dynamic in the way that they invest and position themselves, because this kind of uncertain environment is going to continue for any foreseeable future.
Leo, it's Maura here in Asia. Speaking of nationalization, General Motors and the impending bankruptcy proceedings that will begin on Monday, it seems pretty much done and dusted that it will enter into bankruptcy, and the question is how it evolves after that. But does that, at least for now, take out the market risk of GM imploding?
It seems that it's going to be a fairly controlled process, and what is puzzling is comparing the current forecasts for this process with the initial assessment of what a bankruptcy for automakers would mean in terms of job losses and deterioration of economy, etc. So what we're getting now as a forecast is very different from the initial arguments for the bailout, and it remains to be seen just how many jobs are lost and what impact it has, not just near-term on employment, but in general.
Let me bring this argument back to this side of the Atlantic as well. Andy, huge debate about whether it's about jobs or whether it's about the bigger picture as well. But if it was just about jobs, then the German government will be saving Arkandor, which is basically a retailer with a travel agents attached to it, rather than saving the GM European operations.
Yeah, I think, there's a temptation, isn't there, when you're in government to actually try and hold on to as many jobs as you can, keep the public happy, and they're going to vote for you next time round. As we said earlier, what capitalism does is sort of, it takes resources away from areas which aren't doing well, and you're not earning decent returns, into other areas. And for so long, car makers, airlines, all these sort of industries have been propped up just to keep, lots of people in work. We've got to have our own car firm, we've got to have our, the Italians, we've got to have our own sort of airline, etc., etc. And now with this sort of worldwide crisis, it does give us an opportunity to say, well, actually, is it really sensible to have all our sort of productive resources making all these cars that we can't really sell to people? And actually, I was saying to someone today, the car makers, probably Volkswagen or whatever, could look a lot more attractive now, because suddenly we've seen a huge reduction in capacity. If you're an equity investor, you actually want to go to areas where capacity is going out rather than where capacity is going in. And for a lot of these old industries, we're now seeing dramatic shrinkage of capacity. This time next year, we might be in a position where loads of car plants have closed, and actually trying to get hold of a car is quite a difficult sort of factor, and suddenly they regain some sort of pricing power.